author of This Way to Wall Street, and today I want to discuss with you the S&P 500. Let's check it out. So once again, we're going to be discussing the S&P 500 today. And the reason why we're going to be discussing the S&P 500 is because, for the most part, that's what is the market. When people refer to the market was up, the market was down, the market was this, the market was that, essentially, you're typically talking about the S&P 500. Now, in a few more episodes or so, we'll talk about the triple Qs, which is the NASDAQ, and also the diamonds, the DIA, which is the Dow Jones Industrial Average. But today we're going to examine the S&P 500, and for the most part, once again, this is what most people are exposed to. When you talk about 401ks, when you talk about 403bs and any type of company-sponsored retirement program, you're typically going to be talking about the S&P 500. Now, depending on your retirement age, you may have more or less of the S&P 500, but most people's exposure to the stock market is through their company-sponsored retirement program, so the S&P 500 is, for the most part, the standard. The market has had, a significant pullback, but I want to strike that term significant. It's had a pullback. It's not necessarily significant, but for those of us that are paying close attention, the market may be ringing a bell. We associate a bell with school, right? The bell gets rung and school's out. Well, school might be out, but at the same time, we're still going to continue to ride the long-term trend, which has been, up for the majority of the past decade. This week, the market gapped down, which you can see right here. And a gap is a place where it left some prices that weren't met, right? So right around here, you had a close of around 441.33, and then the next Monday, this was on Friday. On Monday, it opened up right here around 435. So there was about 6 points right here where it just gapped down and missed those prices and opened down here. Now, conventional wisdom says that gaps are typically filled, but that's not always true, and you have a couple extenuating factors on this chart that may give a little more credence to the thought that it might not get filled. And once again, we're talking about the S&P 500, which is what most people are exposed to, whether they know it or not. So a couple things to point out on this chart are these lines. So right here we have a trend line. A trend line, for those of us that are, very new to this, a trend line is a line that connects the most recent lows and gives you the overall direction. And then in a down market, it would connect the most recent highs and give you the downtrend. So right here, we're in a significant uptrend. This is a daily chart of the S&P 500 going back to April of last year. So as you can see, it's been up with periodic pulls backs to this line and rallying after that. This blue line right here is a 20-day moving average. A 20-day moving average is a consensus of value over 20 days. So this line is an average. So each day a price gets added and a price drops off, and then that whole 20 days is added, divided by 20, and that's the average price on each day. So this one follows it pretty closely. The slower moving average is the 50-day moving average. Once again, this is 50 days worth of closes that are added up, divided by 50, and each day you get a dot. And then you connect these dots day after day after day. And this is a 50-day moving average, which is a little less responsive to daily fluctuations and doesn't follow the prices as quickly as the 20-day moving average. So those three things that we just talked about, the trend line, which is this green line, the 20-day moving average, which is this blue line, and the 50-day moving average, which is this red line. These are all significant, technical analysis tools that, some of the best technicians in the world use. And they have all been breached. The first one to get breached was this 20-day moving average right here. Got breached by a long candlestick. Now, for once again, those of us that are new, a candlestick is this bar right here, each of these individual bars, which are just a different way to illustrate prices. Now, I'll be talking about candlesticks in a future conversation, but for conversation's sake, a candle is made up of a open, a high, a low, a close. So all that information is contained in here, but always the most important price is the closing price. So the 20-day moving average was breached here. Then the trend line that's pretty much followed this trend over the last year and a half has been breached. And then the slower, and then the slower, less responsive moving average, the 50-day moving average, has also been breached, and once again on a down gap. So, what is it that I'm doing at this moment? Well, what I'm always doing with the S&P 500 is averaging in. Averaging in means that every week, every day, every month, whatever your investment schedule is, you buy the same of the same amount of the same asset over time. And the whole strategy is that time in the market is more significant than timing the market. So the longer you give yourself to win, the more likely it is you are to win. Wall Street is one of the few games in the world that never ends. So you have a lot of time to be right. So the market is something I believe in. It's a basket of 500 stocks that most of the United States invest in, whether they know it or not. And I buy some every week. So that's one thing I'm doing is, I'm buying a little bit, regardless of price every week. So yesterday was September 20th, and I did, use some additional cash and made a buy that, wasn't on my typical weekly schedule. And I try to do that whenever I see a pullback of 2% or more, I'll buy a little more that week. And if I see a pullback of 5 or 10%, I'll buy a little more at those price points too, or those percentage corrections too. Some important things to look at in this chart though, and once again I say that the market may be ringing a bell, is this line right here. This line is support and resistance. Support and resistance, you can think of them like family members, right? It's like especially support. Support is like a family member. It's like when you're in a crisis and you might be in a downward spiral, or you might be at what they say, quote unquote, rock bottom. Your support system comes in. The troops come in. Your family, your relatives, all the people that share interest in you, they come to your rescue, right? Well, support is kind of like that too in the stock market. Sometimes prices come back to a certain point and everybody gets back in and everybody buys more at that point. So these are always important points to look at on the market, and they also switch roles. So what can once be resistance can turn into support, and support once breached can become resistance. So over here at about the price of 420, you can see that the S&P 500, it struggled a little bit, right? It bounced off it came back, bounced off its 50-day moving average, retested it again, came back, retested the 20-day moving average, finally broke through, pulled back to the trend line, and then broke through on very high volume. That's another conversation we'll have, but that was a really good break there on high volume. So after it rallied, it kind of, as you can see, pulled back to this point at 420, right? So it struggled to break it, went way up to 435, which was a nice strong move, and came back and retested 420. So to me, this area is significant. And once again, all this activity happened again on more than average volume. So whenever you see more than average volume at the same price, that kind of means it's a little more important. So I'm definitely paying attention to this area 420. What am I going to do if it hits 420, which isn't that far away? It went up a little past 450, pulled back to 435, which is around a 5% correction. If it comes down to 420, I'm going to buy more than I typically would. So yeah, that's my near term strategy. Near term means 3 weeks to 3 months in investing. So anywhere over the next month to quarter, if it comes back and retests this area, I'll definitely buy more than average. But one thing to pay attention to, and once again, I say the market, may be ringing a bell, is these indicators here. So what's happening here is actually called a bearish divergence. A bearish divergence means not good. It means that what the price is telling us is different than what the indicators are telling us. And our indicators, once again, they're all manipulations of price. So we get our indicators with formulas that use price as their input. And so, they're never to be taken as importantly as price. Price is always king, and then your indicators sometimes confirm, sometimes don't confirm, but price is king, and we're always paying attention to that first. But market may be ringing a bell. Once again, broke all these lines right here. Our indicator, the MACD histogram, is forming a bearish divergence, which means that even though prices are going up, the indicator is going down, right? You see these lines, the MACD lines. This peak, it was up here. This peak, it was down a little further. This peak, it was down a little further, right? And then our histogram, which measures the difference between these two lines, and I didn't draw the line, but it takes a big push right here, a big breath, right? Bam, nice rally by the bulls. And then you get another rally here, but not as deep of a breath or as long of a breath as this one right here. And then right here, this last push right here, another big move by the market, and this difference was even lower in breadth and length, right? So you have a peak, a peak, a peak, a lower peak, a peak, and even lower peak. So this tells me that it may be losing a little strength, and taken into context with all three lines being breached, I'm very interested in this area in the chart. So right now, that's my strategy. I'm going to be buying a little bit of the S&P 500 every week, and if it pulls back to this area 420, I'm gonna buy a little bit more than average, but definitely save some money for future moves. And once again, I'm always really focused on what's been happening long term, right? I mean, this is what if you have a 401k, if you have a 403b, this is what your money's been doing over the lifespan of that program. It's been going up, and there's been some declines, and so forth and so on. A lot of noise, a lot of news, but the S&P 500 is a proven investment vehicle, and I'm going to continue executing my strategy on a week by week basis. Don't forget to check out This Way to Wall Street, a guide to getting started. I look forward to spending more time with you, and until then, please feel free to message me if you have any questions.